I'm Chad Trevos.
And I'm Dooner.
And we're coming to you in Chicago, November 12th through 13th at the McCormick Center.
At FreightWaves Live, and we're bringing our podcast, What the Truck, the deep dish pizza of freight. Go to FreightWaves.com and get your tickets now.
Welcome to Weekly Rate Update. I'm Craig Fuller here with John Paul Hampstead. JP, it's Breast Cancer Awareness Month. I see you are wearing your pink.
Yep. It's an exciting time of the year. A lot of great research is happening. A lot of obviously preventative care, to remind ourselves of. It's a great cause to support, and a lot of progress is being made.
Yeah, absolutely. And if you can give, be sure to do that. There's actually a link directly on the FreightWaves website.
Cool.
That folks can go ahead and connect into the foundation. So JP, this is earnings, started the earnings season, started last week, continued on this week. We're getting really good data on how the large public carriers are performing. I think it's interesting because when we've talked about this, about 6 weeks ago, we were pretty bullish on Q3.
Right.
We sort of backed off that assessment over the last couple of weeks just because there was that surge never really happened. We had some seasonal uptick, but not of any great momentum.
Yeah, the year-over-year volume comps went from being about 8% growth to about 1%. So, it seemed like, even though we know that capacity is slowly tightening, there hasn't been like a shock to the system enough to really move pricing.
No, I think volumes have been sluggish. We had, imports. There was a lot of building up inventories in warehouses around the country. That has sufficiently supplied the market. Typically, the long haul over the road spot market has been really, really tough this year, simply because there isn't the need to sort of expedite the freight. You can use alternative modes, or you can let it sit in the warehouse until you need it. And so there hasn't been that sort of demand surge that you would typically expect.
Interesting. I do think that the earnings have been some of our best data. I listened to Echo Global Logistics earnings. All the analysts were trying to get management to kind of call the cycle, asking like, do you expect spot rates to come up? Are we going to see margin compression? Are we through, have we already bottomed? Are we getting back to the upswing? And, of course, Dave Menzel and Doug Wagner didn't want to, guide that sort of specifically, but they were like, going forward, that's, we anticipate that. That's how the cycles typically work. We don't know about the exact timing.
Yeah, analysts are always trying to nail down, they want someone to call the bottom. The good news is, if you look at sort of the sentiment, is that everybody's capitulated. And we've been talking about this for 9 months. Is back in the first quarter, there was almost this, with some of the larger public truckload guys, there was sort of this defiant, the market's not in bad shape, it's great, I don't know why you guys have downgraded our stock. Their stocks have been completely beat up. That capitulation is actually really important because what it does is it forces all the weak money to exit. And once you call the bottom, then everybody can sort of look for, we know we're near the bottom. We know that the market has gone into some sort of contraction. Mm-hmm. Now we can start thinking about when does it start to come back up? And that should create some recovery in some of the stock prices. In fact, some of the truckload stocks on transportation stocks have recently rallied. Yeah. Even at a time when the economic data has been fairly, I would say, soft or down. The stocks are actually doing better than they were earlier this year.
I noticed this morning Deutsche Bank raised Old Dominion's price target after they missed, basically saying, and I think George Abernathy was actually talking about this the other day. When Old Dominion misses, that's like the bellwether of like, okay, we're at the bottom. Yeah. Like it's going up from here.
Yeah. Look, if the broader economy goes into some sort of deep recession, then all bets are off. We've seen this happen before. True. In 2007, you had a freight recession, and then you actually had a market that improved for a couple of months. I think it was 6 to 9 months, and then it actually collapsed again once the broader financial market sort of showed distress. So I think assuming that the broader economy doesn't go into a deep recession, I think a soft recession may not overly hurt the freight market too much. But assuming the broader economy doesn't go into a deep, protracted recession, we may be okay, and this may be near the bottom.
Yeah, it's interesting. I mean, if you look at the spot rates, they're still, week on week, month on month, they're still fairly sideways. We're looking at national average long haul dry van spot rates around $1.40 a mile. Interestingly, listening to Forward Air's earnings, they actually had like higher revenue per hundredweight. There's something about LTL pricing that's a little bit more
But keep in mind, they're
resilient.
not an LTL carrier like an Old Dominion is. They do airport to airport, price per pound air freight, or near air freight. And I think they're benefiting from...
So they have a different pricing structure.
Well, it's also a entirely different market. Because if you look at Forward Air's market, they price on a per pound basis. It's dimensional weight, so they are versus classes, which you typically see in the larger LTL carrier. It's dimmed weight, and it's through their airport to airport network, which tends to be it provides supplemental capacity to the air cargo industry. And so when you see things like the 737 MAX be taken out of the market, there was a lot of wider aircraft that actually left the air freight market and took a lot of capacity out of it. And so when you do that, you're opening up a lot of need for expedited LTL that goes to the airport. The other thing that benefits Forward Air is the fact that their market is sort of oversized fugly freight. They're like a universal fugly freight expedite provider, which means that they're benefiting from some of the trends where you're seeing with Watkin Shepherd exiting the market. They're benefiting from Wayfair building up better logistics expertise. And so Forward Air...
They started doing the pickup and delivery stuff as well as airport to airport. And I think that kind of... That is plays to your point. Just that that's a very tough business to be in. And the
they do
exit of some of
exceptionally
those
well.
companies.
I know that painfully well. For when you're
a very steady company, honestly.
Well, it's probably 80% market share of that airport to airport market, and what they are doing now is trying to position their network, because it's like if you're trying to run a scheduled network, they have the most scheduled LTL network on the planet. Like they have specific cut times. It looks like it operates like an airline, except it's using trucks and not airlines. So they have a very scheduled, regimented sort of operating practice on meeting schedules. And because of that, if you're in the e-commerce world and you have freight that doesn't fit well inside of a belly of an aircraft, or frankly freight that doesn't mix well with traditional LTL where you're high
pallets,
and tight, then Forward Air's network is exceptionally well positioned, which is likely the reason that they're seeing some level of increase in
in the revenue per hundredweight.
Revenue per hundredweight, because there's just more demand, and they may be benefiting from some of the resets of like Watkin Shepherd exiting the market or Schneider shut down the last mile. That actually may be somewhat of what they're benefiting from. And
to continue on this kind of rates theme, on the other hand, Werner Enterprises kind of they reported negative 5.6% growth in revenue per mile. So, I believe that's all miles, for the tractor, not just loaded miles. So that might have empty miles mixed in with it, but that's a case where we're seeing, truckload, contract. I mean, negative 5% is honestly moving back up. It's on an easier comp, right? We were down 10%, earlier this year. If you looked at like Q2 versus Q2 18, it was much worse numbers. So I mean, I think there's some reason to expect things to keep getting better. Well, I mean, we have comps, as you talked about, year-over-year comps, which just basically means when you're comparing against last year. Right. This year, we're moving into a cycle where the market started to deteriorate. Yeah. So it gets, as you look year-over-year, it looks,
your relative performance looks better than it did before because you have softness.
Yeah.
And the question that I would ask, JP, is are you seeing any pressure on spot rates going forward?
Upward pressure?
Yeah.
Not really. They've been, I mean, week on week they move up and down a little bit, but they're pretty range bound, honestly. I think Chicago to Atlanta is doing well. We'll see with LA to Dallas. I know that sort of long haul tender rejections out of Los Angeles have spiked recently. That could be just because of repositioning. We noticed that there's a lot of flow going into sort of weird warehousey markets like Stockton, Norfolk, Waco, places like that. So we're still trying to kind of figure out what that means for the market and what that kind of means for Q4. But if that persists, I mean, if they keep tender rejections above 9% coming out of Los Angeles, that will eventually move rates.
Yeah, I mean, look, let's keep it in perspective. When you go back to last year, tender rejections were in the 20s and mid-teens. So 9% is better than
9% is better than 3%.
3% where we were 2 weeks ago, but it's still not great. And this is a seasonal development.
Correct.
I mean, you always see LA and the West Coast start to accelerate. It's just not going to be a fantastic end of the year.
No, it's not. I mean, port volumes are good. 2018 was better. I mean, port volumes now are better than 2017, but it's still not the crazy year we had. And to the extent that you think 2018 brought a lot of excess inventory onto the shore, you know, a lot of the freight might already be where it needs to be.
Yeah, for sure. And that will, of course, mute rates. The beneficiaries of that will be the dedicated fleet operators that are running tours between DC to stores because it's just going to be more stuff in the distribution centers. And they're certainly benefiting from the on-demand last minute or same-day delivery
Yeah,
cycle.
and it just kind of seems like the consumer will be buying, but you know, there isn't going to be, like you said, like long haul expedited, like frenzied spot market activity to move product, you know, in reach of the customer.
No,
like
I think we'll see a number of major bankruptcies as well. I think there'll be continue what we've seen over the last couple of months is more bankruptcies. I think particularly moving into next year, because if I'm running a trucking company and I'm short on cash, if I have peak coming, I'm thinking, well, maybe I can at least survive it. If things get rough running into early next year and there's any sort of concern on just the overall recession, some of those banks may actually foreclose on some of the trucks that maybe sort of are reacting to that. So we'll see what happens. It's going to be an interesting close of the year. Lots of stuff happening. We're going to dive into this and do a weekly rate update live at FreightWaves Live on the desk. Really excited about that. Tons of conversations taking place at FreightWaves Live. If you haven't got your tickets, be sure to do that today. It is going to be awesome. Lots of conversations about the market. We're going to have live production crews, both on our podcast team is going to be there, our radio team, our audio team is going to be there, and our TV is going to be broadcasting live from the floor of FreightWaves Live. We'll see you there.
Our industry is moving faster than ever. Where are freight volumes headed? How will this affect capacity? And of course, what's the newest technology that can benefit your business? Those questions and many more will be answered at the industry's hottest freight tech conference this November in Chicago. Come join us at FreightWaves Live November 12th and 13th at the McCormick Center. Visit FreightWavesLive.com to register.